The annual U.S. tax filing deadline, April 15th, has just passed. Every year around this time, I tend to see two very typical types of families. The first group is those who have already completed their tax returns. Once the numbers are finalized, they may realize that their tax outcomes are higher than expected, which may lead to a sense of surprise or the need for further review. The second group is those who filed an extension. They are still in the final stage of organizing documents, coordinating assets, confirming income and deductions, hoping to avoid unnecessary tax burdens. What I want to point out is this: although these two groups appear to be in different situations, they are often facing the same underlying issue. That is, their family wealth structure may not have been fully aligned with their current financial situation. Filing taxes is only the result. The tax return is only feedback. What truly determines the outcome is the quality of wealth planning over the past year and often over many years. 1. Why do many people only discover problems after filing taxes? Many families assume, I earn a good income, I have investments, I already have retirement accounts, life seems to be running normally, so it is easy to develop a perception that their financial situation is functioning adequately. But tax reporting often provides a clearer view of financial outcomes. For many people, the tax return becomes the first time they clearly see. Income increased, but the structure did not evolve. Assets grew, but allocations were never optimized. Investments made money, but tax efficiency was poor. Family wealth expanded, but the system remained stuck in an earlier stage. For example, a high-income professional whose W-2 income has steadily risen, while investment accounts have accumulated substantial cash and interest income. Yet over the past several years, there was never a coordinated review of maximizing retirement account opportunities, proper placement of assets between taxable and retirement accounts, tax impact of dividends and interest income, annual estimated tax planning. Then when the tax bill arrives, they suddenly realize a significant portion of cash flow may be impacted by tax obligations. This is not simply because income is high. It is because wealth grew, but the financial system did not grow with it. Many people are not paying for taxes alone. They might pay for the cumulative effect of planning decisions and structural issue over time. 2. Making money on investments does not mean wealth is efficient. Another common situation is when families realize the tax impact only after investment gains are realized. For example, selling stocks, mutual funds, or company office restricted stock units, generating strong profits, but without advanced planning around spreading gains across multiple tax years, coordinating gains with losses, timing capital gain harvesting, using capital loss harvesting opportunities, anticipating future tax bracket changes. The result, the assets made money, but in some cases, tax outcomes may reduce the net amount retained after investment gains. This highlights something many families overlook: investment returns are not the same as wealth efficiency. Sophisticated wealth management does not only look at returns, it also considers after-tax net return, stability of cash flow, level of risk exposure, long-term sustainability. Many people notice the money they make. Managing after-tax outcomes is a more important aspect of overall financial planning. 3. Why do high net worth families file extensions? Many people assume filing an extension simply means procrastination, being too busy, or not having documents ready. But for families with more complex financial lives, it is often much deeper than that. Common reasons behind extensions include multiple sources of income still needing coordination, partnership K-1 documents not yet received, foreign asset records still being organized and aligned with U.S. tax reporting, self-employment income and expense records still needing confirmation, complex investment transactions requiring basis reconciliation, charitable giving and deduction documentation still pending, the family's overall tax filing strategy requiring reassessment. So, in many cases, filing an extension really means the family wealth system has been given a window to reorganize. For example, a self-employed individual may know total revenue clearly, but expense records are scattered. Vehicle use, home office, business travel, contractor payments, software subscriptions, and other records were never organized consistently throughout the year. By tax season, everything must be assembled in a rush. The issue is not that tax software is inadequate. The issue is there was no financial system being managed during the year. Filing an extension is not always delayed. Sometimes it is the final opportunity for a complex family to correct structural problems. 4. What can still be done after tax season? If you filed an extension or if you completed your return and now recognize certain issues, this is still a highly valuable moment. There may still be areas worth reviewing, depending on individual circumstances. First, have retirement account opportunities been fully used? Accounts such as IRA, SEP IRA, and Solo 401k may still deserve attention. Different income structures create different planning paths. Second, are self-employment records and expenses complete? Revenue matters, but expense organization matters just as much. Poor records often create direct efficiency loss. Third, is there a coordinated strategy for gains and losses in investment accounts? Were gains pursued while ignoring after-tax outcomes? Were annual tax loss harvesting opportunities missed? Fourth, are foreign assets and foreign tax credits coordinated properly? This is especially common for cross-border families. The issue is often not asset size, but system integration. Fifth, does the filing structure align with the long-term family plan? This year's filing status is only surface level. Long-term retirement withdrawals, Roth conversions, and estate pathways may matter more. Sixth, was charitable giving, gifting, and legacy moves planned in advance? Many decisions produce very different outcomes when planned before the end of the year rather than handled during tax season. After filing taxes, some individuals may find it helpful to reflect on potential improvements. It is turning what you discovered this year into next year's structural improvement. Five, what may be considered in more complex financial situations? Some families with more complex financial situations may not only consider, how much tax can we save this year? They often ask, is our asset structure clear and rational? Is our income and cash flow stable? Is our retirement pathway becoming clearer? Is our investment system tax aware and efficient? Is family protection placed properly? Is wealth transfer being prepared early? Are cross-border assets coordinated consistently? Because the real major cost is rarely 1 year of higher taxes. It is the financial outcome led by certain structural inefficiencies over years. The shock of one tax bill is temporary, but long-term structural considerations could have a meaningful impact over time. April 15th has already passed, but for those who truly value wealth management, wealth planning season is just beginning. If this year's tax return made you realize certain issues, that may not be a bad thing, because meaningful change for many families begins the first time they clearly see the structure. This can be the opening window to proactively consider and discuss with qualified financial advisors and experienced tax professionals questions such as, is my income structure appropriate? Are my assets positioned correctly? Does my investment strategy consider tax efficiency? Is my retirement cash flow path clear? Does my family have an overall wealth blueprint? If today's topic is important to you, and you would like a deeper discussion on how to make your family wealth operate with more direction and greater efficiency, you may consider discussing these topics with qualified financial, tax, or legal professionals. Many families periodically review their financial structure as part of normal financial planning. See you next time!